Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Byte. We are shooting this episode on 30th of May, and the market continues its ramp up regardless of what global headwinds we face. But first, let me go through a FAQ for small case users. I think this is very important, and a lot of users have been asking us for a detail on this. So we are going through this. So there is a facility of auto renew on the small case platform. Uh, this change had come some time back, where the platform did does not anymore allow a subscription to be on a manual renewal mode. The platform only allows an auto renewal mode, and that is the decision of the platform, not a decision of weekend investing. But nevertheless, I just want to clear the air about this auto renewal business so that all users can use it without any inhibition. Now, first, that all weekend investing strategies are created as long-term investment vehicles. So, you anyway should not be looking at not renewing it the next year for the next 4 or 5 years, because if you are coming in only for 11 months or 12 months, that year may or may not be the one where you will get that momentum boost. So ideal time is 4 plus years. Auto renewal as an option, and that is probably why the platform also wants you to auto renew, is to have a longer term view on strategies. It helps you seamlessly renew your subscription without a break, and the hassle at the end of each subscription period that you may have to go through. So this is the thesis behind why auto renewal is there. Some people have this doubt that whether my card data is safe or not. So your card details are absolutely safe. Uh, the auto debit that happens on each subscription works like any other subscriptions, like maybe a Netflix or a Google account, or anything that you may see online. This card detail does not come to weekend investing. It stays at the payment gateway level. So it stays at the Razor Pay, which is the payment gateway for small case level. It does not even go to the small case uh, hands, and definitely does not come to the weekend investing uh, hands. The other doubts are that if one subscribes to a auto debit or auto renewal, will I be able to cancel the subscription at any given point of time? So please be assured that there is no restriction that you will be auto renewed or auto debited. If you anytime the next day after you subscribe, if you want to get out of the auto debit, you can do so. You can cancel your subscription. It will go till the point of your expiry of your subscription and end there. You can go to your accounts within the app, small case app, click on subscriptions and select the option cancel subscription. It is as simple as that to cancel the auto debit or the auto renewal. Now you may ask that what if I forget about the auto renewal at the end of 1 year, and so on and so forth. So there is no question asked at that point also. If you subscribe to the strategy and if you auto renew, please let us know within a day of that happening, that you've auto renewed but you did not want to auto renew. We are happy to refund your subscriptions, and you can write to support at weekend investing for any of your queries on that front. So please be totally carefree about the fact of this auto renewal. I know a lot of you have been extremely concerned about this data, and whether you'll be able to get out of the auto renewal, and what if you forget about the auto renewal and it renews. So please be assured that there will be emails going. If it is auto renews, you just send us a mail within 24 hours to cancel it. We'll cancel and refund it, not an issue at all. And you can also cancel and cancel the subscription at any point of time. So now to look at the markets today, we essentially had a another gain in the Nifty, and we are now another inch closer to the all-time high. The momentum of going up has slowed since this bottom of 16,800, but yet we are still going up, so nothing wrong in that. You can see here on the Nifty heat map a sort of a mixed day with banking and finance slightly green, IT slightly green, FMCG sort of flattish, but more red in infra, in steel, in autos, and some energy stocks. And you can see here the sectoral overview. FMCG up 0.6%, private banking, public sector enterprise, IT, consumption stocks up marginally. And the biggest loser here is the metal index. There is news from China that the consumption is slowing down for steel there. The property market is cooling off, and when Chinese demand cools off, then metals will have a tough time, the prices for them to go up anyhow. So that is the news for the day. Whether it sticks or not, I don't know, but the market was extremely mixed given these various sectors. Mid caps, however, are in a run of its own, a fresh new high of 33,600. Small caps taking rest today, but still, the trend is very much up. Bank Nifty has closed at yet another high at 4436, looking extremely good. No issues about it. A lot of people are spreading rumors about, market is at all time high, but stocks are not at all time high. So there is some conspiracy theory happening. I think don't pay too much attention to all these conspiracy theories. More than 99% of them fail. So don't give too much attention to it. Today's topic is to allow the stocks to speak to you. So, I mean, it's kind of a funny topic, you may say, but more often than not, we have a plethora of reasons why we buy a stock. Most of you are discretionary investors, and you would buy a stock basis, maybe some valuation metrics, some of the parts, some discounted cash flow, some relative valuation versus other stocks. Or you may feel that the stock is cheap because in the past it has had higher valuation. Or you may like the product. You may drive the car and really like that company. You may eat a biscuit and you may really like that company. You may see hoardings of that company all around you. You may feel that the stock will go up. You are seeing visibility of that company. Or somebody's told you that XYZ is likely to go up. You are convinced with that person because he's had past successes. There could be a plethora of reasons why you are buying a stock, but none of these reasons are actually matching, or at least I would say, taking into cognizance that the stock may have already discounted the factors that you feel are yet to be discounted. How will you figure it out? So for instance, some companies, you know expansion plan is there. They've announced we will expand so much in the next 2 years. Stock has already gone up a bit. How will you really figure out how much the stock needs to go up more at this stage? It's very difficult. So it's basically your confidence, your forecast about that stock, assuming that the rest of the market has not been able to price it properly. You as an individual have been able to catch something in that news item or that balance sheet or that quarterly results which others probably have not seen. So this kind of myth you should not have. The market is a very, very smart market. There are smart people, millions of them in this market. So try not to have this view that what I'm seeing in the results, or what I'm seeing in the balance sheet, or what I can think about this company, nobody else can do that. So I think that is very, it's sort of a ego sort of an issue, that me and I know more than the market kind of situation. So me being from the momentum investing school of thought, we don't pay attention to what our thought about that stock is. We say, let the stock tell us a story, and our thesis for momentum investing is buy what goes up, sell what goes down. That is all. That's all our strategies are built upon. That is the basis. If the stock is not going up, we will not buy it. If the stock is not coming down, we are not going to sell it. Let it go 10x, 20x, 40x, whatever it may do. If the stock is not falling, we will not get out of it. So you need to be very, very clear about what your rules of engagement are, and only then you will remain out of ambiguity. Yes, every style will have its pluses and minuses, but at least there is crystal clarity about what you're doing and what you expect from your strategy. Now, let's take an example. So this stock, I had tweeted about this stock a couple of days back, yesterday in fact. uh, Usha Martin. So now Usha Martin has been a stock in the market on NSE since 2004, and for the first 16 years it went up really high from 10 rupees to 140, and then it gradually came back to 10 rupees. That was the story of the first 15 years on the market. And then in the next 2 years, it went from near 10 rupees to 240 rupees. So 24x kind of a jump, 20 to 24x kind of a jump over the next 2 years. So 15 years of one big jump and then consolidation for the next 12 years, and one jump of 20x in 2 years. So the stock actually gave you like 3 4 opportunities in this entire 20-year period, where it said a couple of times that I'm going up, if you want you can buy me, I'm coming down, if you want you can sell me. It's as simple as that. Now somebody who may have bought here, who may have bought here, who may have bought here, they would have had so much pain for next 10 years, uh, that it would be very difficult for them to wait out for this to play out, because once you are in deep pain for a elongated period of time, you are looking for the first opportunity to get out. Imagine somebody even buying after this fall here at 20 rupees, then again looking at 20 going to 100, again coming back to 20, again 20 going to 40, coming back to 10, again 40, coming back to 15. Next time it would go to 40, it will hit that person will go to get out, most likely than not. Or it will go to 60, you'll get out, or it'll go to 100, you'll get out. But because you are not looking at the design that I will not sell till the stock drops, for instance. So you will remain either stuck in a sideways stock, or you will waste that opportunity cost of that entire capital for so many years. So another stock was Adani Enterprise, for instance. This stock, while it went up 27x in the last few years and fell down 75% after that, but it had been in the market for almost 14 years before this. And the first 14 years it did go up 15x, but it was extremely choppy, going up, coming down, going up, coming down, going up, coming down. And then finally it went up with a huge leap, and with a huge crash down there also. So even a small part of this entire rally, if you were able to catch by listening to the stock as it was going up, you would have significantly made significant money. So different phases, I'll not go into the detail of this, but you get the idea, that buy what is going up, sell what is going down. So the insight here is that the world is changing. There is no doubt about that. Let's not kid ourselves by saying that, it's not the same as 80s and 90s, where some companies had some licenses or some moat, and they were not disrupted for the next 30 years. That era is mostly gone. World is becoming more and more dynamic. There is more and more disruption. Capital has become extremely cheap. uh, People are able to spend a lot of venture money to disrupt industries. uh, S&P index average lifespan of a company is constantly coming down. McKinsey report points to about 12 years by the end of this decade. So if the S&P 500 average company has a lifespan of just 12 years, any company really has not much of long runway that you can really bet upon. So in such times, buy, hold, and sleep becomes extremely difficult to adopt. You have to be more dynamic in your allocation as well as exits, and following the price, having strong set of rules, what to buy, when to buy, how much to buy, and when to sell really helps, and will help more in this environment as you go up. So central banks all over the world are printing like crazy. That is lifting all asset boards up. So absolute valuation will not have much meaning left. If the world had $10 trillion of money, then stock market valuations were such. Now they have $30 trillion of money, and markets have gone up. So now you cannot compare the current valuation with what was available 20 years back, because the base money has gone up. So what was a great price earnings ratio 20 years back is nowhere to be found. Earlier, the Nifty used to come back to price earnings of 10 before people really got excited and bought again, but now it doesn't come near even 15. So things are changing. There is dynamism in terms of how models are changing, especially on valuation metrics. So relative valuation becomes more logical, because you are able to compare assets, but allowing the stock to tell you when to buy and when to sell remains the best insight that I could think of. So thank you so much for watching this, and I'll see you in the next one. Bye. And if you're not subscribed so far, please do so. Please like the video and do subscribe to it. Thank you. Bye.